Good day, folks. Today we're going to take a little look at what's called the DuPont analysis. And this methodology goes back into the 1920s when the DuPont Corporation tried to analyze their performance, but the performance of potential acquisition. They wanted to see what was really driving their return on equity. So this is an approach by which it actually tries to take return on equity, which is net income divided by average common equity. So what they do is they try to break it down so that we can see where it is. They use financial and leverage ratios to explain that profitability ratio. And it's a more detailed and comprehensive approach, but it helps us identify what is driving it. So what we have is it tells us that ROE is driven by three things. Operating efficiency, and that's a function of the profit margin, which is net income to sales. Asset efficiency, how efficient are you using your asset, which is measured by total asset turnover, which is assets divided by sales. Financial leverage, which is measured by the equity multiplier. Then you add them all up. So let's just take a brief look at some discussion about the DuPont analysis.
Hi, my name is Scott Shuttleworth from Montgomery Investment Management and welcome to this week's video insight. Today I'm going to be taking you through DuPont Analysis, which is a powerful tool for analysing why exactly a company is profitable. Now, it divides profit into three factors and we'll be going through them in turn. But firstly, let's have a bit of a look at the context and history of the DuPont model. Now, the DuPont model was first devised by Frank Brown, who was an electrical engineer at DuPont. Now, in 1917 to 1919, DuPont acquired a position in General Motors, and Frank was asked to have a look into the company and see, well, what have we actually got here? He devised a series of financial ratios and some financial management tools, and one of them was the DuPont model. So let's take a look at it. Now, as we know, return on equity is simply earnings over equity, but DuPont Analysis allows us to break this down even further into these three factors: earnings over sales, sales over assets, and assets over equity. So let's look a bit further. We can call each one of these factors a name. So as I said, the earnings over sales factor we can call the net profit margin, as we know. The sales over assets factor is a scale factor. For example, if I put in $1 of assets, how much sales can I get from that asset? And the last factor, which we'll go into more detail later, is the leverage factor, assets over equity. Now, we're going to start up a company, and it's under the inspired name of Lemonade Stand Pty Ltd. It's been running for a year and it has a set of financial metrics. It's got sales of $10, profit of $2, assets of $10, and equity of $10. Let's use the DuPont framework to have a look at this company. Now, as I stated earlier, its net profit margin, earnings over sales, is 20%. Its scale factor, i.e. sales over assets, $10 over $10 is 1, and its leverage factor, assets over equity, $10 over $10 is also 1. So if we look at the return on equity for this company, i.e. this one, we can see that most of the return on equity is driven by the net profit margin, not so much these other factors. Let's start up another company and see how we go. Now, another company that we have here is under the inspired name of Pencils R Us Pty Ltd. Pencils R Us has sales of $100, profit of $2, assets of $10, and again equity of $10. Let's use the DuPont framework. We can see that the net profit margin is very, very low at 2%. But what drives the earnings for this firm is the scale factor at 10. And then the leverage factor again doesn't contribute that much. So we can see that for this firm, as I said, the returns on equity is driven by scale. It's sort of akin to Walmart if you think about it. It invests a lot, but then it gets massive sales over its assets. So our next company is worldwide trading concern P2R Ltd. It has sales of $10, profit of $1, assets of $10, and equity of $2. Now, its return on equity is a massive 50%. That's generated by the net profit margin of 10%, a scale factor of 1, and a leverage factor of 5. So whilst net profit margin does contribute here, the main factor is the leverage. So now that we've seen a few companies and we've seen what really drives their earnings, we can start to ask some questions. So for example, for firms that have a high net profit margin, we can say, well, obviously the returns of this company is linked to that net profit margin. So why is that net profit margin persisting? I mean, lemonade stand P2 Ltd just makes lemonade. It's quite a commodity good. But it must have some certain quality. It must be of a certain flavour for people to be willing to pay the margin. If you suspect in the future that that's not going to be sustainable, well, you might have to reconsider investing in that company. What if scale is driving the return on equity? Well, how does that scale come about? Do they have to invest, billions and billions of dollars to be able to get that scale? Do they have to have some kind of patentable technology? Do they have to devise some technology? You can always ask these questions, find the answers to them, and then see, well, can competitors replicate that? And finally, leverage. Now this is a bit of a tricky one. So firstly, obviously a bank or something like that would have high leverage, and if you invest in it, then you have to consider that risk. But if it's not a bank and you still see there's high leverage, then you have to ask yourself, can the firm, what's driving that leverage? It could be debt, and then you have to ask yourself, am I willing to accept that amount of risk? Or it could be some other factor. For example, the company might get a lot of inventory from its suppliers on very good terms, 360-day terms. And if it's a piece of inventory, you might consider, well, they can probably sell it within 360 days. And in that case, leverage factor might be a strong competitive advantage for that firm. So these are the DuPont factors. I hope that's been useful to you. We will join you again next week, but until that time, please follow us on Facebook and Twitter.
If we come back, this is a way of breaking it down. So here's the regular ROE, return on equity, where you take net income divided by average equity. Then ROE equals net income divided by sales, sales divided by assets, assets divided by equity. So what we end up with then is net profit margin times asset turnover times leverage. Here's an example on STLD, where it looks like they have a very healthy, right here, you can see 1376 return on equity, 2533. So we want to say, well, that's great. We initially look at that and say, that's great. But what's driving that number? And when we come down, we see that 10.62, when we look at the net profit margin this year, we look at the asset turnover and the leverage, we come back. So we can see that a lot of the return is driven by the leverage and asset turnover. So that gives you a sense of how it's employed, and saying that we can increase this by more profit, or we can increase it by more efficient use of the assets or the leverage. And a rising ROE suggests that the company is increasing its ability to generate profit without needing as much capital. A high level of debt can artificially boost the ROE. After all, the more debt a company has, the less shareholder equity it has as a percentage of total assets, and thus its higher return on equity. The DuPont analysis essentially provides a more accurate assessment of the changes in ROE by focusing on the means that the company uses to achieve a return on. That includes the gross profit, asset utilization, and financial leverage, also known as financial gearing. And you'll find that this really moves right along with the discussion we had on